Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known as Mr. Valuation. In fact, that's very pertinent to today's video because today I'm going to talk about what is stock valuation. That's the theme of today's video. And the best way for me to do that is move into the FastGraphs Fundamentals Analyzer software tool that I co-developed. And let's look at valuation and what creates valuation, where it comes from, and why it's so important. So let's go ahead and move into FastGraphs. All right, the first company I'm going to look at is a company called Ameriprise Financial. And I want to talk a little bit about, as I start this, the art and science of stock valuations. Because when it comes to investing in the stock market, one question really towers above all the others. What is a stock really worth? This is the essence of stock valuations, the process of determining the intrinsic value of a company's shares. Now, in FastGraphs, we utilize different methodologies. We incorporate several methodologies, which I'll discuss in a moment, that create this orange line, which is the intrinsic value line on FastGraphs. Okay, that line represents what the stock is actually worth. Okay, so as I said, as investors, our goal is to buy stocks when they are undervalued and sell them when they are overvalued. So let's dig into the heart of company stock valuation and why it matters so much for your financial future. First of all, you got to understand that stock valuation is more than just a number. At its core, stock valuation is the analytical process of determining the fair value of a company's business. FastGraphs does that task for you by drawing this orange line, and I'll talk about how that orange line is created in a moment. But the important point is it isn't just about looking at current price on your screen like a Google Finance or Yahoo Finance or somewhere like that. It's about understanding first and foremost what the business is worth based on its fundamentals, things like earnings, growth prospects, assets, and even risks, which are critically important. Now, there are several methods to approach share valuation. Some investors prefer the simplicity of the price-to-earnings ratios. But a lot of people misunderstand what even the price-earnings ratio means. It's just a measurement, okay? It's an indicator. It's really, I like the inverse of the price-to-earnings ratio, which is the earnings yield. And the earnings yield tells you how much return you would be getting from investing in this company based on what the earnings of the company would yield you, just like what a dividend would yield you, okay? So again, it's not just about looking at current price. Now, other people like to think about things like discounted cash flow analysis. FastGraphs is actually incorporating discounted cash flow analysis into our tool when we draw this line. The discount rate we're using is a 15 PE ratio's inverse or earnings yield of 6.67%. Now, some people talk about using treasury bills, riskless yields, and so on. We are focused on what the company's growth is going to be, and understanding that a fair value of 6.67%, or let's say 6 to 7% to keep it more straightforward and simple, represents a minimum return you should expect if you invest in a common stock. And the point is, if the business is generating that through the ability of creating the earnings that it's doing, and by the way, you can interchange words like cash flow. FastGraphs would also show you things like operating cash flow of the business. We would also show you other forms of cash flow like EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And of course, we would also utilize things like sales. All of these are available on the FastGraphs Fundamentals Analyzer software tool. But earnings are what is widely reported. You see it in the news all the time. In fact, right now we're in earnings season, and you're seeing a lot of these companies are reporting earnings today. And of course, those earnings will have an impact on the stock price. Now, there's besides discounted cash flow analysis, we also use Ben Graham's intrinsic value formula. When companies are growing at less than 5%, we use a pure version of Ben Graham's formula to draw the graphs. And a company that would illustrate that would be something like Campbell's Soup. If you look at it's now called Campbell's, but the Campbell's Soup Company, it only has a 2% growth. And so what we're doing is we're utilizing the Ben Graham's intrinsic value formula, which you can look up on Google, and creating an intrinsic value line. In this case, it turns out to be a fair value of just under 13. So this line is a PE ratio of 13. All right. Now, the point I want to get at here when you're looking at these things are that stock value, besides its imperfections, are never going to be perfect. So the key is to use these tools to separate the noise from the ever volatile stock market and the stock market valuation landscape. Now, again, the FastGraphs Fundamental Analyzer tool clearly expresses this relationship. Now, what I've got on here is a picture of Ameriprise, which was a spinoff from American Express, an asset management and custody bank company. And I'm going to put weekly closing stock prices on the graph. And this is a 15 PE ratio, which is the orange line, which is representing the intrinsic value. And what you can clearly see by looking, just glancing at a fast graph, is times when the stock is trading below its intrinsic value, which represents bargains, obviously. And then they'll see times when the price is above the orange line, which would represent a high valuation or an overvaluation situation. Okay, but the point is we use these methods that I've talked about, discounted cash flow, the Ben Graham formula, and the growth rate of the business, and we provide these fair valuation references, but we also provide evidence. The evidence is this. When you look at Ameriprise, if I looked at Ameriprise and did not look at the orange line and just looked at the stock price, I see a lot of ups and downs in the stock price, but it's not until I put the business behind the stock on the graph that you see whether the price is trading below its intrinsic value, above it, or so on. And you'll see that with company after company. Here's FedEx, which is more cyclical in nature. And once again, you see how the price tracks earnings over time. And when earnings got real volatile, so did the stock price. But you always had, by looking at a fast graph, you always had this perspective of whether the stock was cheap, expensive, or actually what was going on with fundamentals. This is coming into COVID here. All right, you look at a stock like Cummins, and this is another cyclical company. And this is, Cummins mostly known for their diesel engines. Look how the stock price tracks the earnings of the company. And clearly you see periods of high valuation. Now, when you buy a stock like this, you can pay more than it's worth and still make money, especially if it ends up several years later like it is now, being overvalued. But what you also have to recognize is you're taking more risk. Because if you wait a year and buy the stock when it's fairly valued or slightly undervalued, your rate of return almost doubles from 14% to 29%, because valuation matters, and it matters a lot. Okay, so that's very important to know, because imagine yourself walking into a store and seeing two identical products, one priced at 10 and the other at 20. These products are identical now. Which would you buy? Now, the answer is clearly obvious, but the stock market prices are constantly shifting, and the product, the company itself, is constantly changing. So valuation in stocks helps you determine whether you're getting a bargain or overpaying. You're overpaying here you're getting a bargain. And that's going to determine what your return is. Now, if a company is growing consistently, you can even pay high valuations for the stock. Like here in June of 2014, you could have bought Cummins at almost a 20 PE. And if you held it to fair value, forget about the fact that it's overvalued, you still made 8 or 9%. Okay, but if you waited and bought this stock when it was trading at a more reasonable PE ratio and held it to fair value, your rate of return increases dramatically, almost to 11% a year. And over time, that means a lot. So when you buy a stock without considering its valuation, you're essentially gambling, you're speculating, you're not investing. But when you anchor your decisions in sound valuation principles, you become an investor, someone who understands the difference between price and value. Like Warren Buffett said, everybody knows the price of everything and the value of nothing, okay? Because you also got to understand, and I've said this so many times in previous videos, the stock market is a voting machine in the short term, and it's a weighing machine in the long term. Prices can swing wildly based on news, sentiment, macroeconomic events, what have you. However, over time, the market tends to reward companies that grow earnings. And you see that clearly when you look at any fast graph. Even here's a graph of Meta. Over time, the market, now here you're using a P equals growth rate, Peter Lynch's formula. You're using a very high multiple to measure Meta, but you can see that Meta's long-term return, even if you'd have paid this crazy PE of 88 on its IPO, and notice how it fell after its IPO, which is basically consistent with most IPOs, and held it to pretty close to today, you'd have averaged over 26%, turning $10,000 into just under $250,000. But as Meta has gotten bigger and the law of large numbers comes into place, the growth rate has begun to slow down. So here now we're valuing the stock at a 20 multiple, which is more realistic over this period of time for this growth rate. And if I shorten the time frame even more, we now have earnings growth down to 15%, or just maybe call it 16%. But the market is actually dramatically overvaluing the company. All right. And so when I'm looking at forecasting what the future is, analysts, and there's a lot of them, 60 analysts that follow this stock, believe this company is going to grow at 18% or just under 18% a year. But because the valuation is so high, the stock is very vulnerable. And by the way, they announced earnings today. And if you take a quick look at what happened to their earnings today, the stock is down 10%. It's down almost $76 a share. And I would argue that the vulnerability of that has to do with the fact that here's a company that's worth essentially somewhere in terms of intrinsic value of $420 a share to something, because earnings are expected to be down this year, to maybe, we'll call it $418 to $420, and yet it's trading at this valuation of $751. That is where risk, that's how you would ascertain or determine risk. Okay, so stock valuation is really critical, but let's break down some of the main approaches to stock valuation a little bit. A lot of people like to talk about relative valuation. They compare a company's valuation metric like price-earnings ratio or price to book or enterprise value to EBITDA to peers or the market average. That is, I don't think, a realistic view of valuation. It's showing valuation relative to the peers. But if you got a very strong sentiment in the market and valuations are extraordinarily high, that doesn't mean you're getting good value. It can still mean that you're overpaying for the stock. I prefer absolute valuation, calculating the present value of a company's expected future cash flows, in other words, discounted cash flow analysis, or asset-based valuation, assessing the value of a company's assets minus its liabilities. In other words, I'm looking for absolute fundamental valuation. Now, every method of doing this has its strengths and weaknesses, but ultimately, I believe fundamental value is what really matters, as you can see by the evidence provided by these so many stocks I'm showing. You can look at a lot of different companies on the Fast Graph tool. We have 80,000 stock symbols available, and you can always see this relationship that exists between price and value. All right, and when you see that, you always know what kind of risk you're taking. You also understand how the market's acting, because market sentiment does impact valuations. Okay, the collective mood or attitude of investors does play a profound role in shaping valuations in the short run. While traditional valuation methods like fundamentals like earnings, cash flows, and growth prospects that I favor can drive prices above or below what those fundamentals might suggest in the short run. In other words, sentiment can trump valuation in the short run. But in the long run, fundamentals matter the most. And recognizing when the market misappraises a stock is the key to controlling risk and succeeding with strong fundamentals in the long run. So let's look at a couple of really, I'm going to call them popular examples. Let's look at Apple. And let's analyze what I've talked about so far in this video, okay? Because you got to remember, the market will always have its moods, but value endures. True valuation is lasting. Emotions like fear and greed are ephemeral, and they can come and go. So I urge you, focus on what a business is truly worth, not just what it's trading for today, but recognize what it's trading for today and understand it. So here's a long-term graph of Apple. Going back to 2005, Apple has grown earnings at an average of about 31 or 32% a year. But I want you to note something. Back in 2005, they grew earnings by over 300%, then 46% in 2006, then 73%. And these numbers, they threw out another big number in 2010, 140 and 83. But go into future time and you start seeing that the growth gets harder and harder to come by, even though they still have the occasional great year. Now, this was coming off of COVID, which was an opportunity for them to really grow. But if I shorten this time frame, I suddenly discover that earnings growth has been about 14%, not 30% plus. It's been cut in half. And the market was trading at that 13% growth coming into COVID. But then recently we've had these very high valuations. Now, as I've said over and over again, just because it's overvalued doesn't mean you can't make money. Apple has still generated some pretty good rates of return. But let me show you something. If you're just comparing Apple to the S&P 500, all right, what you're going to find out is that by running these different time frames, let me change the time frame here to 16 years. And you're going to see that Apple has outperformed the market during that 16-year period rather strongly. But then I go to 13 years, and you start to discover that, well, let me go a little shorter. Let me go to 10 years, looking at performance here. And all of a sudden, we see the market and Apple starting to converge. We now get into shorter time frames, like the last 7 or 8 years. And now all of a sudden, Apple and the market are almost neutral. Not quite. Apple still winning, but not quite. You go to the last 6 years of history, and Apple's now all of a sudden underperforming the stock market. Still performing great, by the way, but underperforming the stock market. But what I think you really have to understand is that by looking at fair value relative to current stock price, like you see here, you need to be able to recognize that you're taking great risk. And note, as I change time frames, these numbers change, because that's why Fast Graphs is such a powerful analytical tool. Okay, it allows you to basically recognize those things. Now, when investor sentiment is optimistic, okay, well, let me back up. Let's talk about the power of a valuation discipline. In the end, stock market valuations are both art and science. They require a blend of quantitative analysis and qualitative judgment. By mastering the principles of company stock valuation and maintaining a disciplined approach to share valuation, you can navigate these ups and downs of the market with confidence. Remember, the market's always going to have its moods, but value endures. As I again urge you, focus on what a business is truly worth, not just on what it's trading for today. But when investor sentiment is optimistic, like it is currently in this bull market we've been in, stocks often trade at higher valuation multiples. This is true during bull markets or periods of economic expansion, when enthusiasm and confidence push prices up, sometimes to levels that outpace the underlying business performance. And conversely, during times of fear or pessimism, such as economic downturns, corrections, or bear markets, valuations can fall sharply. And we saw that, for example, during COVID with all these, every stock I've shown you today. During the COVID, there was a quick drop in stock market prices, okay? So when sentiment turns negative, valuations can drop, and sometimes more than fundamentals would justify. So let's talk about sentiment and volatility and the emotional roller coaster that comes with that. First of all, market sentiment is highly sensitive and can change very quickly. If you look at some of the stocks that have gone through this here recently, like if you look, and I showed this, I did videos on this in the past. If you look at a stock like Fiserv, for example, here's a company that the market was applying a premium valuation on ever since 2014. But then all of a sudden it gets this really extreme valuation, which is a picture of extreme risk in the stock. Notice the last time coming into COVID, it was highly valued. COVID took the thunder out of it, or the wind out of its sails. But even if you look at the next several years here, we had very poor performance, actually negative performance on this company, even though fundamentals were growing by double-digit rates during that period of time. What was out of sync was the valuation was way higher than the fundamentals justified. Then we kind of got back into fair value for a moment. Then the market hype came on again. And all of a sudden we had this really high valuation. And then the stock has subsequently corrected and it dropped over 70%. That's an 83% annualized negative rate of return over a very short period of time. That is a pure picture of risk. So in behavioral finance, they often talk about why sentiment matters. They've demonstrated that investor psychology and emotions are significant drivers of prices in the short run. You see that very clearly by looking at this stock, okay? And if you look at stocks like Apple and Nvidia, which we just looked at Apple, look at Nvidia. Now, if I look at Nvidia, you can see this relationship between stock price and earnings growth when Nvidia was behaving, I'll call it normally or rationally. You can see how the price was tracking earnings growth. But when earnings growth got very strong, we saw the stock price rise dramatically. During this period from 2016 through, let's say, September, October of 2018, it was averaging 130% annually per year. But now let me move this forward and look at the valuation. Now, we're drawing a 53 PE ratio here, but we're also seeing where the market was applying, the blue line on the graph, a 40 PE. Okay, that becomes kind of a more relevant valuation reference, in my opinion, when I'm looking at this stock. So as I look to the future, the market's expecting over 30% growth. That's an extraordinary number. But sentiment has driven the price as a result of that growth to a PE ratio that's over 50, which is not supported by the fundamental values here. So if you bought it today and it ended up trading at a appropriate 30 multiple, let's say 2 years from now, you could still make 8 or 9% a year. But you could also face the risk of seeing your stock drop in value, especially over the shorter run, because it's overvalued like we talked about. That just recently happened to Meta. Okay, so market sentiment significantly influences company valuations in the short run, sometimes more than the fundamentals. As an investor, it's crucial for us to recognize when sentiment is driving prices and to remain disciplined in our approach to valuation in stocks. Nothing does this better than the FastGraph Fundamental Analyzer software tool. With FastGraphs, you can always see where the price is relative to the intrinsic value of the company. So when you understand the emotional currents of the market, you can better navigate the ups and downs and make more informed decisions. You look at a stock, a company that I've owned for years and years, and it behaved beautifully, just like the philosophy that I'm espousing here dictated. Look how Oracle's stock price tracked a 15 multiple for all these years. Now along comes AI, that creates a lot of emotion, it creates a lot of support, and all of a sudden it's recognizable, it should be recognizable at least, that Oracle is no longer a bargain. When you should have bought Oracle was when the price was more in line with growth. Or even here, now we are looking at some forecasting numbers that expect Oracle to grow at maybe 22% a year going forward. Historically, it's grown about half that rate. So that is strong opportunity. But again, what price do you pay for that? And I'm going to argue that a 43 PE is not a fair price. Now, it doesn't mean you're going to get killed, but you probably don't stand to make much money if you invest in a stock like Oracle at these extremely high valuations. Anyway, this is Chuck Carnevale, co-founder of FastGraph. Hope you enjoyed this video on what makes stock valuations and why they matter. And I hope you recognize how when you have the perspective of the fundamental worth of your business, and then you can focus on how the market's valuing that business, then you can make sure that you're only buying bargains. Or if you're taking the risk of speculating in a high flyer like Nvidia, or even Apple for that matter, that you're doing it. You're doing it with your eyes wide open. But I believe you should always have a strong sense of what a business that you invest in, what a stock is really capable of providing you in terms of rate of return based on the business results that it's able to achieve. Hope you enjoyed this video. If you did, ring the bell, give me a like, subscribe to the channel if you haven't already, because this is all about fundamental investing and investing as a value investor, which I believe is the true path to long-term success. Thanks for watching.